it's about giving back. It's about finding enjoyment through not only what you're doing, but the impact that you can make.
Hello, my name is Abhilash Jayakumar, and I'm the co-founder and managing director of Trust Vista. On today's Trust Vista Talk, I have the pleasure of being accompanied by Richard Beleutz. Richard is an accomplished deal maker who has completed over $1 billion of total transactions throughout his career. He started his career with Ameriprise for over 10 years, then ran a hedge fund at Beleutz & Associates, and has been a managing partner at Alternative Investment Resources since 2004, and is currently the CEO of Air Asset Management, a longevity-based hedge fund. Richard, thank you so much for joining us.
Thank you, Abby, for having me.
AIR, Alternative Investments Resources, alternative investments, a lot of things to a lot of different people, but you are certainly very alternative. Can you tell us a little bit about what it is that AIR is doing?
So Alternative Investment Resource, obviously an acronym for AIR. AIR Asset Management is really focused on the specialty finance area of private credit. So we're an asset manager. So we have a series of hedge fund products. We have some private equity structures. We're managing just shy of $500 million, so about $460 million in total assets under management currently, in a number of different structures. So we buy longevity-based investments, and we do some.
Can you tell us a little bit more about longevity-based investments? What all does that encompass?
So for us, longevity-based is anything that is tied to a lifespan of an individual. We buy life insurance policies, which are called life settlements, typically from seniors who don't want or don't need them. We provide them liquidity in a socially responsible manner. We also buy structured settlements or annuity streams from folks that would prefer to utilize the lump sum for some beneficial purpose, like buying a house or starting a business. So anything associated with those. Also, we do some lending against those and related asset classes as well.
And certainly a large and growing market. How did you first get into this space?
So I first learned about life settlements back in 2006. And why the space was really compelling and interesting to me was because of my background as a financial advisor and a branch manager over at Ameriprise. From 93 to 2004, I sold these products. I sold insurance, I sold mutual funds, I sold annuities, I sold financial advice. So I understood the product from a financial advisor's perspective. Also, from 2002 to 2003 and as early as 1998, I was involved in another financial product arbitrage related to mutual funds, and I knew the potential of a good financial product arbitrage. The reason why I liked the life settlements, better than the mutual fund trade we were doing is because the life insurance trade is very client aligned. You're putting significant capital into seniors' pockets that otherwise probably would have just lapsed their policy. So it's money that found money that they didn't know that they had. And so the fact that it was very client aligned, in addition to being very profitable, taught me that this trade had some legs.
Yeah, certainly it's created a new option for seniors with the idea of being able to monetize their policies that they've built over a lifetime rather than letting what would otherwise be an investment go to zero. But talk to me a little bit about how you went from seeing this market opportunity to actually becoming an entrepreneur and stepping away from a job you had for 10 years. Now it seems in these days nobody holds down a job for 10 years. Now the term is great resignations generation. But tell me, what drove you to step out onto your own?
So, for me, the thing that was interesting about the life settlement space in our first entrepreneurial initiative was really the opportunity set. So my first entry into life settlements was in 2007. Learned about the opportunity in 2006 and formed a partnership, myself and 4 individuals. in 2007, and we launched a company that was focused on brokerage in the space. We launched a hedge fund in the space and a life expectancy company. So we saw a good market opportunity. We got investor capital to back us, and we entered the space. So it was really just a compelling opportunity. One of the reasons that I had interest in moving into the institutional space from kind of the retail space, from the financial planning side of it, was really driven by the scalability of the institutional side, and kind of the intellectual stimulation that I got from solving the institutional problems versus kind of a retail situation.
So you started a financial services business a year before Lehman Brothers collapsed. What were those early years like for you?
I mean, 2007 was great. I mean, things are going straight up, and we had lots of opportunity. We were putting together lots of interesting business deals. So on the way, into Bear Stearns and Lehman, it was exciting. And even after Bear Stearns went down, there was still at that time, for those that are old enough in the financial business to recall, it was just supposed to be a blip, and it was supposed to have a pretty quick recovery. Obviously, when Lehman went down, I think people realized that it was a lot more significant than maybe a lot of the companies were leading on. And for us, we never scaled that group of businesses large enough into the credit crisis really to survive. We ended up winding those businesses down in 2010. Our hedge fund we wound down in 2009 because we lost our leverage facility when our bank went under and was bailed out by 3 European governments. And so for us, we are able to return our money to our investors, within the hedge fund, and they made positive 8% for 2008. So they had a positive return, so that was good. And then our life expectancy company, was really geared around securitizations. When we realized that wasn't coming back anytime soon, we wound that down, and there wasn't a lot of ability to do third-party brokerage. And so I exited the life settlement space in 2010. But what came with me was a lot of lessons on and a lot of understanding of how that particular market, the life settlement market, worked. And so I had an opportunity to re-enter in 2014. We did that, and hence here we are today.
Yeah, they say failure is the best teacher, but sometimes it doesn't feel that way when you're in the middle of it.
No, but I had the mindset. I mean, I knew when 2008 hit, I knew there was going to be some tough oaring ahead. But it motivated me. It motivated me to stay focused. It motivated me to work hard. I didn't realize how long it was going to take, to really, come out of that environment. But where there's change, there's opportunity, and I knew there was going to be opportunity. I didn't really know what that opportunity was going to be. And when I left the life settlements market, I didn't know if I was going to come back. I knew I enjoyed the market. I just knew that there wasn't enough volume and activity in the space for new participants. That opportunity came on the upswell, years later.
And do you think it would have even been possible for you to do this in 2014 without that experience?
No, it wouldn't have, because the reason I came back in was at the invitation of one of our business partners. Somebody who I'd met back in 2008, and somebody who was very accomplished in the space. And they needed a strategic partner in the U.S. So through that invitation, to become a U.S. partner with a established firm out in Luxembourg, that really gave us our start. And then a few years later, we started launching our own products. So it really it really gave me the opportunity. Is the the tuition I paid in terms of sweat, blood, and tears back in the credit crisis is paying dividends today.
Talking about the pandemic, having that experience then, what was your response and reaction when the pandemic first started, and how have you kind of navigated the last year and a half?
So when my reaction when the pandemic first started, I mean, we're in the business. We have mortality exposure. So we are long mortality when it comes to our structured settlement book, but we're short mortality when it comes to our life settlement book. So the first question naturally is I wonder how this is going to affect the performance of our book. The second question is I wonder about the infrastructure of the industry, whether that's going to be changed. What's the solvency of the insurance companies? What's the ability for folks to continue to transact? How's this going to affect the liquidity markets? Those types of things. In terms of what we saw thereafter is we saw, with the exception of a few corners in the marketplace, the industry has adapted very well. So, for us, we've had to react. We've had things that have been a result of this, but we've been able to continue our performance. We've been able to continue to hire people and continue to grow our assets and our product base. So for us, being at the size we were at that time and being nimble, we've been able to be flexible and adaptable enough to continue to grow in a challenging environment.
Now, you mentioned that when you look at purchasing policies, you do it in a socially responsible way, right? Why is that important to say?
So for us, there's two reasons. One is it aligns with my personal philosophical beliefs. I'm a capitalist, right? I'm in finance, and we manage hedge fund products and private equity products, and so I'm an economics major from undergrad. So for me, I understand P&L and economic motivation. But there's also a social motivation, and that's where the ESG, or the socially responsible component, comes in. It's about giving back. It's about finding enjoyment through not only what you're doing, but the impact that you can make. And when we really kind of figured out, because it wasn't right away that we figured out that we always knew that life settlements had a social component to it, right? But we didn't know that investors would start classifying it as an ESG category until socially responsible investors started coming to us. And I asked the question, I was like, I see the value that we provide to seniors, because through the testimonials, through the industry, through the marketplace, we know, but the broader world, at that time, thought the space was a little quirky because it dealt in mortality, and maybe because of the reputation of space in the early days when it wasn't heavily regulated. There's some stories out there, and people were afraid of the space. But what the socially responsible investors were telling us was that senior financial independence is one of the largest needs, on the social part of the ESG, and life settlements is one of the pure ways where you can impact seniors' lives by putting dollars in their pockets that they didn't know that they had. And so they wanted to support it, and it fit their buckets. And so we've written articles on it, and there's a number of research pieces. London School of Economics did a nice piece years back on it. And that shows the value that this product puts in people's pockets.
You mentioned how there was maybe certain bad actors in the early days of this market, or misconceptions about what it could mean. How has the market evolved in terms of acceptance of the product as it relates to addressable market size, and what is the opportunity for continued growth?
Yeah, so the market's evolved. So this is kind of the pre-2008 era. There was something called stranger-owned life insurance, where insurance brokers would go to the country club and they would manufacture policies. They would finance the seniors to get life insurance so they could take it and flip it. And life insurance, you can sell. There's a 1911 Supreme Court case, Grisby versus Russell, that says that life insurance is property that can be bought or sold. But when that life insurance policy is initiated for the first time in the primary market for insurance, there needs to be insurable interest as a part of that contract for the beneficiary. So third-party investors don't have insurable interest from that standpoint. It's got to be a loved one, a spouse, or a business partner, or somebody, a charity, or somebody along those lines, where there's a bona fide business purpose. And so these brokers were manufacturing these policies, which was against the rules, and they might go or they would go out and broker a policy. They find a legitimate policy from a senior, and they get a $500,000 bid, and they go tell the senior that they have a $250,000 offer, and they would keep the other $250,000 undisclosed, to the senior. And so what has happened subsequent is now, at the time was maybe regulated in 14 states. Now life settlements are regulated in some capacity in 46 states. So things like commission disclosure for the brokerage market is now mandatory in most states. And so, there hasn't been a consumer complaint in the life settlement space in the last 5 years. I can't tell you how many other industries can say that, not many. So you have a space that now has a very clean record of providing value that's considered socially responsible. In terms of your question on the growth of the space, the market currently is, call it, if we talk in death benefit, it might be, it's hard to know the exact numbers, but might be 150 billion in total death benefit globally in third-party insurance that's owned. This is on the backdrop of a $23 trillion U.S. life insurance industry in terms of total death benefit. So it's actually a small fraction of the overall life insurance business. Less than 25% of seniors today are aware that life settlements is an option. That's up from 10% back in the credit crisis, but still leaves a lot of opportunity. You have a ton of baby boomers who are now getting into the sweet spot for life settlements in terms of age, kind of late 70s, 80s. So you have a lot of supply that is coming online. So it's projected that it'll maybe triple between now and the year 2030 in terms of the overall volume that's transaction in the secondary market. So we think that the demographics support that, and the number of policies support that, and so we think that there's going to be more liquidity, and it's going to continue to grow.
And of that 23 trillion, do you have a sense in any given year what percent of policies are lapsing because people don't know better?
Well, it's a huge percentage. Over 90% of life insurance eventually lapses.
Wow.
So, the vast majority of life insurance never has to pay out a death benefit. So all those premium dollars folks are paying through, it could be their worked group term, it could be private term, it could be permanent insurance. Somehow, some way, those policies are lapsing before the person dies. And so hence is the opportunity. The life insurance companies price the policies where the premiums are less than the actual statistics of holding a pool of people, chipping their money into a pot and paying out folks upon death. That's because of that lapse rate. And hence, that's where the life settlement industry has an opportunity from a financial arbitrage perspective.
And from an origination perspective, these individuals that are actually learning about selling their policies, how do you actually come to then buy them? You're not knocking on people's doors one at a time, obviously. So how does that transaction actually practically play out?
Yeah, so the way that the transaction market works in life settlements, we call this the secondary market for life settlement, which is defined as when a senior or an individual is selling or settling their policy for the first time in the market. The tertiary is an investor-to-investor market, which is our liquidity markets. And I mentioned the primary market is when that policy was issued for the first time. But that secondary market is really broken down into two components. The first component is the secondary market, the brokerage market for the secondary market. So the brokerage market consists of life settlement brokers whose job, they're licensed with the Insurance Commission, and their job is to call on the estate planners, the accountants, the financial advisors, the insurance agents, and educate them on their fiduciary duty to let their clients know that selling their policy is an option if they no longer want or need it. So that's one component, and that's the majority of the market. That could be, call it 75% of the traded market. It comes through the brokerage market. And then there's the direct-to-consumer market, which is the ads that you may have seen on cable TV, et cetera. It's not just television ads, it's radio, it's print, it's media, et cetera. But that's the direct-to-consumer market. And that tends to be more of the smaller, kind of policy holders tend to call on the 800 number, and the larger policy holders tend to, get access to the market through the brokerage channels. We, as an investor and a buyer, we buy through the secondary market as we're required through a licensed life settlement provider. So we utilize a third-party provider that's licensed, and they connect and communicate with the brokerage community, much like a real estate transaction. So it's a broker-to-broker market, and the brokers are established counterparties that know each other, and we bid on policies based on underwriting parameters, risk, et cetera. Or what we'll do is we'll back some of the direct-to-consumer programs. So some of the advertisers and marketing companies that are out there going to generate leads online will be the money behind that. So that's typically how we access through the secondary market. Of course, we have policy flow in portfolios that we acquire through the tertiary market. That's our network of existing investors that we do a lot of trading with. But in terms of the origination side, it's through those brokered markets.
And looking at the other side of the equation, your investors into your fund and your product, obviously this has a very different risk return profile than investing in, Tesla stock. How do they view you as an asset class? Where do you fit in a portfolio theory?
So for us, we can fit in a number of different places. Where I like to explain us is within the specialty finance area of private credit, as it sits within the private debt space. So when you can be considered alternative fixed income, sometimes it'll be niche market neutral. Folks will put it in their private equity bucket if it's a closed-end structure. It'll be in their hedge fund bucket if they're investing in an open-end structure. So there is a lot of flexibility, but most of our investors consider it like a private credit investment.
So from a business growth perspective, where do you see the business going from here?
So for us, we love the longevity space. It, as you mentioned earlier, it does have some capacity constraints to it. But for us, we really love the specialty finance area within private credit. So some of the things that we're getting involved with are like legal finance space. We're looking at the trade finance space, other niche areas that are non-correlated, that are kind of all-weather, high single-digit, low double-digit returns that are really driven off of the assets. And as an asset management firm, what we typically do, like we enter the life settlement space, is we'll partner with an existing firm that's very established in the space, and then we'll allocate to them through one of our multi-strategy structures, or we'll build our own, kind of separately managed account investable product vehicle, and we'll bring investors into it from that perspective. So, for us, it's just expanding, in asset classes. Obviously, we'll continue to grow our exposure in the longevity space, which has been principally life settlements and secondarily structured settlements, and then, from a third, perspective, the lending that we're doing. So we'll continue to grow that, but we'll also add new asset classes over time.
And what do you think is the more limiting factor to growth, the supply of investor capital or the supply of policies to acquire?
It's really the dance between the two, right? Because we've had competitors in our space that have taken too much capital in, and the answer is because they could. And the challenge with that is if you grow too fast, you pay too much, and if you need liquidity, you become too large of a share of the marketplace, and you can run into an issue. So there's a little bit of a Goldilocks answer. For us, it's at our size, we have plenty of opportunity to grow before we hit those upper thresholds. So our focus is bringing in the new investors, but bringing in long-term patient investor capital. So rather than kind of the short-term hot capital, and then also making sure that we are continually to increase our sourcing so that those can match. But that's one of the reasons why we are also looking at other asset classes, because investor appetite for non-correlated double-digit return is very, very high. And so as investors start coming in this space and have success with it, there's a lot more capital that tends to flow. And for us as an asset manager, being able to make sure that our investors are properly diversified amongst these niche little spaces is our business opportunity.
You mentioned tertiary markets previously. When you acquire these policies, how does your exit profile look between settlements actually maturing versus liquidating it to another investor?
So roughly half the policies that we buy, we will get a liquidation through a maturity event. The other half we'll get liquidity through selling it. And we sell it in what's called the tertiary market, which is the investor-to-investor market. So we have established trading counterparties that we buy from and then we sell to, and they buy and sell with us. And so there's a network of other asset managers that are continually buying and selling with each other. And that generates the liquidity markets.
So what's the motivation between wanting to hold a policy till maturity or creating liquidity through a tertiary transaction?
For us, it's about risk management. So the biggest risk in a life settlement is you buy, let's say, a life insurance policy for $2 million on an 80-year-old individual. So the biggest, and they have a 10-year life expectancy. So the biggest risk is that person lives 15 years, right? Because the amount you pay for the policy plus all the premiums that you pay for it can be significant over time. And you can actually lose money on a policy that you hold 15 years and matures if you pay too much for the policy. Part of what we do is we focus on low cost acquisition, and we have more of a quantitative trading mentality, and we view these as financial instruments. And so we don't get attached to a medical view on the policy or trying to predict how quickly somebody's going to expire. We focus on acquiring these policies. We will harvest mortality through our, call it short to medium term hold period, which might be 3 to 5 years. But then we'll sell the policies off in the open market, typically at a gain. And then we've made money on the policy, and we just mitigated the number one risk in the space. And a certain number of those policies will mature early, and our mortality book. So our mortality book is the IRR on that is off the charts, because we're just taking the early unexpected mortalities. Our trading book is reasonable, kind of low double-digit returns, and then we've just mitigated our number one risk. So that's kind of how we view mortality versus trading.
And from a regulatory environment, there's a lot of talk about estate taxes, changes in regulatory environment. Is anything happening currently in DC that's concerning you in your industry?
No, I mean, DC, well, the biggest thing that we've noticed is the insurance market is really regulated on a state-by-state basis. So when we look at the trends on, from the state insurance commissions and from state to state, one of the things we've noticed is there's been more states that have been requiring notification by the carriers to the seniors that life settlements is an option if they're going to lapse their policy. So we've actually gotten, regulatory support from the insurance commissions on notifying that folks that this is an option, which has been great. From a regulatory standpoint, there have been some lobbying efforts by our industry to include a kind of like a healthcare savings account, where when you settle your policy, if you utilize the proceeds for long-term care and health expenses, it can be done on a tax-free basis. So, there is some momentum in Congress, if you can call it that, on a bipartisan basis to get that attached to some type of bill. But that's kind of the development that I would say that I'm aware of, but it's actually positive so far.
A $500 million private equity fund might have 20 investments in it. Obviously, a $500 million private investment strategy is going to have many more positions in life settlements. You have many, many individual policies. How practically do you manage the portfolio?
So we have a servicer, evaluation agent, and we have our provider who acts as our trading house. So, the servicing role that this group has for us is, very critical. What they do is they track the mortality of the individual. So they have services that do that. They pay the premiums. They make sure the policies are enforced and the data files are tight and the information is collected. What we do on the portfolio level is we manage the risk. So we do the risk management piece. We focus on the trading, the portfolio construction. So that's what we do on our side. So a lot of the grunt work, heavy lifting is outsourced, and kind of the higher level strategy, portfolio management, risk management is done in-house.
We've been privileged to be your partners and see you growing over the last several years. Can you maybe just talk a little bit about how you guys have positioned yourself in the industry and how you performed versus other players in the space?
So we're, for the time frame that our funds invested, we're the top performing hedge fund in the space. We have, a strong track record. Part of the reason, and a very strong part of the reason we've been able to perform so well is our investment philosophy, which I'll touch on in a second, and our investment partners that we trade with, and we have an outstanding sub-advisor that also advises us. So that's how we've been able to, do as well as we've done. It's, I'd say we have a sourcing edge. We have a differentiated investment philosophy, which is the quantitative investment philosophy. And then we have a multi-strategy approach where it's not, 100% life settlements. It's, over 80% life settlements, with the other, just under 20% in structured settlements and private credit. And what that does, what that combination of investment does, is something pretty special. By owning life settlements and matching them with structured settlements, we've done two things. One, as I mentioned, with life settlements, we're short mortality, and structured settlements we're long mortality. It's a form of a mortality hedge. Number two, life settlements are very cash intensive. We pay a premium every month. Structured settlements are income producing, so we collect income every month, and same with the private credit. And so when you mesh those two investments together, you have a cash flow match that gives you a lot of cash efficiency, so you don't have just lots of cash sitting around doing nothing. So that's one efficiency component, and plus you have a little bit of a hedge, and you also diversify from a liquidity standpoint. And so that's added some value, and it's really differentiated us in our marketplace. And then just by our trading philosophy and being able to harvest a lot of good mortality through our quantitative approach of buying cheap and buying certain types of policies, we've been able to produce.
Well, that's fantastic. Richard, thank you so much for taking time to speak with us today and telling us about your business and the industry you operate in. It's certainly fascinating, and we'll look forward to seeing you to continue to grow and evolve.
Yep, thanks for having me, Abby.